Nobody saw this coming. Two of the world's largest silver-producing countries have just been hit by developments that could reshape the global silver market. Together, these nations account for nearly half of the world's silver mining output. When something unexpected happens in countries responsible for such a large share of global supply, investors around the world pay attention immediately. Some analysts believe this could become a temporary disruption, while others think it may be the beginning of a much larger story that could affect silver prices for months or even years. Today we are breaking down exactly what happened, why it matters for every silver investor, and what history tells us could happen next. Stay with me until the end, because one overlooked factor could completely change the outlook for silver. Silver has always been different from gold. While gold is primarily viewed as a store of value, silver plays two major roles at the same time. It is a precious metal that investors buy during uncertain times, and it is also one of the most important industrial metals in the modern economy. This unique combination makes silver one of the most fascinating assets in the financial world. Every smartphone, every solar panel, every electric vehicle, and every advanced semiconductor relies on silver because of its unmatched electrical conductivity and reliability. As technology continues advancing, global demand for silver continues growing across multiple industries. That means any disruption to supply immediately becomes an important story. When investors hear that two major silver-producing countries are facing unexpected challenges, the first question they ask is simple: will there be enough silver to meet future demand? The answer is not always straightforward because the silver market is much more complex than many people realize. Unlike many commodities, silver production cannot increase overnight. Developing a new mine requires years of exploration, environmental approvals, financing, infrastructure construction, and workforce development. Even after a project begins construction, it often takes several more years before commercial production starts. This means that if supply suddenly falls, the market cannot quickly replace the missing production. That is one reason silver has experienced sharp price movements during previous supply disruptions. Recent developments have once again reminded investors that global mining depends on political stability, economic conditions, energy availability, transportation networks, and government policy. Any significant change affecting one of these factors can influence production levels. Markets respond long before official production numbers are released because traders always look ahead. They analyze future risks rather than waiting for confirmed shortages. This is exactly what appears to be happening today. Investors are evaluating whether recent events could reduce mining activity, delay future investment, or increase production costs. Even if actual output remains stable, uncertainty alone can influence market sentiment. Another important factor is industrial demand. Unlike previous decades, today's global economy depends more heavily on silver than ever before. Renewable energy continues expanding at an extraordinary pace. Solar installations continue reaching new records across multiple continents. Every large-scale solar project consumes significant amounts of silver. Electric vehicle production also continues growing as manufacturers invest billions of dollars in future transportation technology. Each vehicle contains silver in electrical systems, safety components, charging equipment, and advanced electronics. Artificial intelligence has created another powerful source of demand. Modern data centers require advanced processors, networking equipment, power management systems, and sophisticated cooling technology. Nearly every one of these systems depends on silver because of its exceptional conductive properties. Semiconductor manufacturing remains another rapidly expanding industry. Governments around the world continue investing heavily in domestic chip production to strengthen supply chain security. New fabrication facilities require enormous investments while increasing long-term silver consumption. These trends create a fascinating situation. Industrial demand continues expanding while investors also purchase silver during periods of financial uncertainty. Whenever both forms of demand increase together, silver has historically experienced some of its strongest bull markets. That is why developments affecting major mining countries attract so much attention. Supply represents only one side of the equation. Demand continues moving higher across multiple sectors at the same time. The broader economic environment also remains extremely important. Inflation continues influencing investment decisions around the world. Although inflation has moderated from previous peaks, prices remain significantly higher than historical averages across many sectors. consumers continue facing elevated costs for housing, healthcare, insurance, transportation, and everyday necessities. Whenever purchasing power declines, investors often begin searching for assets capable of preserving long-term wealth. Gold has traditionally played that role. Silver frequently benefits alongside gold, especially when industrial demand remains healthy. The Federal Reserve also remains one of the biggest influences on precious metals. Interest rate expectations continue shaping investor behavior every single week. Higher interest rates generally strengthen the US dollar while creating temporary pressure on gold and silver because investors receive higher returns from fixed income assets. Lower interest rate expectations often produce the opposite effect. Markets therefore analyze every inflation report, employment number, manufacturing survey, and Federal Reserve statement for clues about future monetary policy. The currency market represents another major piece of the puzzle. A stronger dollar usually makes precious metals more expensive for international buyers. A weaker dollar often supports demand by making gold and silver more affordable across global markets. These relationships have repeated themselves through decades of economic cycles. Professional investors understand that no single headline determines long-term prices. Instead, they evaluate multiple factors together: mining supply, industrial demand, investment demand, interest rates, inflation, currency markets, government policy, geopolitical developments, global economic growth. When several of these forces begin moving in the same direction, major market trends often emerge. History provides several important lessons. Previous silver rallies rarely started after perfect economic conditions. They often began during periods of uncertainty when investors questioned whether demand would remain strong or whether supply could keep pace. At first, many people dismissed those concerns. Then, fundamentals gradually became stronger. Eventually, prices responded. The current market contains several similar characteristics. Industrial demand remains historically strong. Global investment in clean energy continues expanding. Artificial intelligence infrastructure continues growing rapidly. Governments continue supporting domestic manufacturing. Central banks continue demonstrating confidence in precious metals through steady gold purchases. Meanwhile, investors continue watching every major economic report for signs that interest rate policy may eventually change. Now another variable has entered the picture. Potential uncertainty surrounding two of the world's largest silver-producing countries. Whether these developments become temporary headlines or longer-lasting challenges remains to be seen. But one thing is already clear. The silver market has entered another period where every piece of new information matters. That is why experienced investors are paying such close attention today. Because history has shown that major changes in the silver market often begin quietly long before the broader public notices what is happening. Markets are now beginning to ask a much bigger question. What happens if supply disruptions last longer than expected, while industrial demand continues rising? This is where the silver market becomes especially interesting because supply and demand are moving in opposite directions. Mining companies cannot simply increase production because prices rise. Every major mining project requires years of planning, billions of dollars in investment, environmental approvals, modern infrastructure, and skilled labor. Even after construction begins, commercial production often remains years away. That means existing mines carry enormous importance. When countries responsible for a significant share of global production experience uncertainty, investors immediately begin calculating possible consequences. Even small reductions in global supply can have an outsized effect when demand continues growing. Silver is not only consumed by investors purchasing coins and bars. Manufacturers around the world require physical silver every single day. Factories producing solar panels cannot simply replace silver with another metal. Electric vehicle manufacturers depend on silver for electrical system sensors and charging technology. Medical equipment manufacturers continue relying on silver because of its unique physical properties. Telecommunications companies require silver in advanced networking equipment. Artificial intelligence infrastructure depends on sophisticated servers, processors, and power management systems that also consume silver. This continuous industrial demand creates a strong foundation beneath the market. Unlike speculative buying, industrial demand usually reflects long-term economic investment rather than short-term emotion. That is why many analysts continue watching manufacturing trends just as closely as investment demand. Recent global investment in renewable energy remains another powerful driver. Countries across North America, Europe, Asia, and the Middle East continue expanding solar energy capacity at record levels. Every new solar installation requires silver. As governments pursue long-term energy independence, these projects continue moving forward despite periods of economic uncertainty. Electric vehicle production follows a similar path. Major automobile manufacturers continue investing billions of dollars into future production facilities. Even if consumer demand temporarily slows, companies continue building factories because they expect long-term growth. Every new production line supports future silver consumption. Another important issue involves inventories. Many investors assume there are unlimited supplies of silver available around the world. The reality is much different. Large portions of annual silver production are immediately consumed by industry. Only a relatively small percentage becomes available for investment products such as coins, bars, and exchange-traded funds. Whenever industrial demand rises while mining supply becomes constrained, available inventories can tighten surprisingly quickly. This has happened during previous market cycles. History shows that silver prices often remain relatively stable until investors suddenly realize physical supplies are becoming more limited. At that point, price movements can accelerate much faster than expected. The Federal Reserve also continues influencing the broader investment environment. Markets remain highly focused on inflation, employment, and economic growth because these factors shape future interest rate expectations. If inflation remains persistent, policymakers may choose to keep interest rates higher for longer. If economic growth slows more rapidly than expected, markets may begin pricing in future rate reductions. Precious metals respond to these changing expectations almost immediately. Investors never wait for official announcements. They constantly attempt to position themselves before monetary policy changes actually occur. The US dollar represents another major influence. Currency strength affects purchasing power across global commodity markets. A stronger dollar generally creates temporary pressure on precious metals. A weaker dollar often provides additional support by encouraging international demand. These relationships explain why experienced investors monitor currency markets every day. Geopolitical uncertainty remains another important variable. International trade disputes, shipping disruptions, regional conflicts, and changing diplomatic relationships all influence commodity markets. Mining companies depend on stable transportation, reliable energy supplies, secure infrastructure, and predictable government policy. Any disruption affecting these conditions increases operational risk. Higher operating costs can eventually influence production decisions. Long-term investors recognize that mining companies face challenges extending far beyond simply extracting ore from the ground. Energy prices, labor availability, environmental regulations, financing costs, transportation, infrastructure, and political stability all affect future production. When several of these pressures appear at the same time, investors naturally become more cautious about future supply. Meanwhile, demand continues following its own path. Central banks continue accumulating gold reserves at historically strong levels. Although central banks focus primarily on gold, their actions reinforce broader confidence in precious metals as long-term stores of value. Private investors often respond by increasing exposure to both gold and silver. Silver has repeatedly demonstrated that it can outperform gold during certain phases of precious metals bull markets. Historically, gold often begins moving first. Silver frequently follows later with larger percentage gains once investor confidence spreads throughout the sector. This pattern has repeated across multiple economic cycles. Of course, markets never move in straight lines. Corrections remain normal. Periods of volatility remain unavoidable. Short-term headlines frequently create emotional reactions that later fade as investors focus once again on long-term fundamentals. Professional investors understand this difference. They avoid making major decisions based solely on one day's news. Instead, they examine broader economic trends, including inflation, industrial demand, mining production, central bank activity, currency movements, and monetary policy. That disciplined approach often provides a clearer picture than reacting emotionally to every headline. Today's silver market contains multiple powerful forces working together. Industrial demand remains historically strong, technology investment continues expanding, renewable energy development continues accelerating, mining uncertainty has increased, interest rate expectations continue evolving. Inflation remains above long-term targets. Global economic uncertainty has not disappeared. When these forces begin interacting, the result can create significant market opportunities. The biggest question now is whether current developments represent a temporary disruption or the beginning of a much larger structural change. The answer may determine where silver heads during the next phase of this market cycle. And when we look at what history has repeatedly shown during similar periods, the outlook becomes even more fascinating.